only there was a way I could make money when the stock market fell in value.
Inverse ETFs.
If only there was a way I could have some sort of insurance in my portfolio.
Inverse ETFs.
If only there was a way I could just buy something that would act like a hedge and protect my other investments.
Bruh, what can't you understand? Inverse ETFs.
I got it. Inverse ETFs.
No!
Thanks for stopping by the channel once again, as we're gonna cover inverse ETFs today. They sound more complicated than they actually are. I'm gonna walk you through it, help you make sense of it, and help you determine if you wanna use them in your portfolio or not. I wanna take a moment to welcome all the new subscribers here. If you have not already subscribed to the channel, I invite you to do so. We make new videos every week around finances, investing, and taxes on this channel to help you build wealth. Let's get into the content as we cover a slightly more advanced investing concept, but I promise it's not very confusing once you get the hang of it. There's not too many things to really know. When you first hear inverse ETF, the first thing you're thinking is, what the heck is it? It sounds like something you're gonna install in your house or install in your car, like in the part of your car that's right next to the flux capacitor.
This is what makes time travel possible. The flux capacitor.
But what an inverse ETF really is a type of ETF that has come about in the last 10 years or so, and it's an exchange traded fund that does the opposite of what the market's doing. An inverse ETF acts like a derivative that allows you to short the market without actually shorting the market. And you might have heard the term short selling passed along here and there. You might have heard that before, but what does it really mean? Well, normally, we grew up, we've heard the stories that you should, when investing, buy low and sell high. Short selling is the complete opposite of that, where you sell high, take the money, and then buy back low. And the difference is the profit in between. That's the concept of short selling. Now, before inverse ETFs, if you actually wanted to short an investment, what you would have to do is you would have to set up a margin account, which with inverse ETFs, I don't believe you have to, and you would have to actually short the investment, whether it's an ETF or an individual company stock. And there's a lot more risk involved when doing that, because normally in the past 100 years, the market generally trends up. And so people who are shorting the market when the market is moving up can lose a lot of money really quickly. Luckily, with inverse ETFs, you don't actually have to short the market, which is amazing. You don't have to figure out any of that complicated stuff. I've done it a few times. Back when oil first took its hard nosedive several years ago, I shorted an oil producing stock and made a 20% return fairly quickly. But since then, I haven't shorted all too often. And that's why when I saw that inverse ETFs were a thing, I got really excited, because I no longer had to sit there in front of my computer to try to perfectly time the market, wondering what my investment is going to do. With an inverse ETF, all you need to do is purchase shares of that ETF, whichever inverse ETF you choose to do so, hold it, and when the market starts to decline in value, then you sell it off and take a quick profit. Early this year, when the stock market started to take a real beating, the fastest crash in stock market history during February of March of 2020, the inverse ETFs in my portfolio went up significantly in a very short period of time. And as the saying goes, the bull climbs slowly up the stairs, but when the bear arrives, the bear jumps out the window. And that's why with inverse ETFs, not only do they act as a great hedge, but they can actually get you a nice quick profit if used correctly. Well, when the stock market went down, the S&P 500 in particular, which is the one I own, SH, ticker symbol SH, hope you guys got that. When the S&P 500 fell, my inverse ETF that shorts the S&P 500 went up in value. How much did it go up in value when the stock market fell? It went up about 30% very quickly. And now, since the stock market's trending back upwards, it started to come back down in value, as you can see from the charts on screen. But nonetheless, had you had that investment in your portfolio, you could easily see how you could make a quick 30% return on your money, 20-30% give or take, if you sell off before the market starts rising once again. You then take that money and then you use that extra cash flow while all of your other investments are down, you sell it, and then you can use that extra money and buy back other investments at a lower price. Now, before you get too excited about inverse ETFs and what they can do, there are a couple cons or things you need to be aware of before diving too deep into these investments. The first con you got to be aware of is it is a derivative, and because there's a lot of work and analysis that goes into building these ETFs, they're a little bit more costly fee-wise, but most of them have a fee ratio of less than 2%, so still typically cheaper than a mutual fund. Secondly, an inverse ETF is not always something you want to hold on to long term. Typically, they are good for a short period of time, where when the market goes down, that's when it's time to sell off the ETF, the inverse ETF, and hopefully you're holding that in your portfolio. Ever since I learned about these inverse ETFs, I've been really curious about how they work. And if you want to learn how they work, this is what I would recommend for you, is actually go to Yahoo Finance and start searching different types of inverse ETFs. Don't worry, you don't have to memorize the list. I'll put a nice list for you in the description section of this video. You can check it out. But if you want to check out a great article on inverse ETFs, please do yourself a favor and go to thebalance.com or search in Google the balance sheet inverse ETFs, and I will leave a link to that article as well. But it has a whole listing of different kinds of these kind of investments that you can choose from. But I recommend looking back on graphs to see how they perform before you get into them. You'll notice that if you look at SH and you look back in history during 2008, you can see how much it went up in value during that time period when the market was crashing so hard. You could have been making so much money had you had one of those hedges in your portfolio. Think of how many other investments you may own or how many investments types of accounts people hold, but they have no insurance, no hedges in place to protect their overall wealth. An inverse ETF is one option that can help you do that, which is why I wanted to talk to you about these in this video. So the rule of thumb is just to keep it simple. When the market is moving up, that's when it's time to maybe come in and consider putting a buck down. When the market moves up, drop a buck on an inverse ETF, because that's when they're falling in value. Now look at the long-term graph of SH. What you'll notice is that in 2008, 2009, it went up significantly. But then for the past 10 years, what was happening to that? It was going down in value as the market was coming back up. But even today, you can see how high our market still is today and how cheap, how inexpensive these investments are still right now, right at this moment. I'm not saying you would allocate a ton of your money into these things, but you might look at adding a few shares every now and then to help buy yourself some insurance in your portfolio so that you do have protection, some protection against the downside. So these are fascinating investments. And there's so many different kinds. I'm not going to go into all the details of how many different kinds there are, but there's an inverse ETF for practically everything you can think of. You can short oil, which if you just did, you would have made a killing. You can short the S&P 500. You can short the Dow Jones. It's known as the dog because it's the dog of the Dow. You can make money when the Dow Jones falls. You can short real estate, financials, utilities, practically anything you can think of, bonds. I think there's even an inverse ETF that shorts FANG stocks, if I'm not mistaken. So check it out. Check out that list. There's some really interesting investments in there. Now, how much should you allocate to one of these hedges? Well, it's really up to you, but I can tell you this. You know, when I analyzed my portfolio just recently, and I've been investing for several years now, about 5 or 6 years, I realized I'm really not that well hedged. My portfolio during this last crash really wasn't that protected, and I could have had a lot more opportunities fall in my lap had I looked a little more carefully at these hedges, had I just known about these a little bit sooner. Well, you know, if you only have 5% of your portfolio in total in a hedge, whether it's a hedge in an inverse ETF, cash, or long-term bonds, short-term bonds, whatever it may be, whatever your hedge of choice is, gold, for example, well then it's not going to offset the rest of your portfolio if, in my opinion at least, if 90% or 95% of your investments are in equities that are going down. It's just, you know, 5% is not going to hold up that ship from crashing. But you might look at, you know, over time, slowly building up insurance in your portfolio. It's gonna be like dead weight, okay? It's gonna be like that Avenger. Think of a superhero where this the one superhero, no matter how hard they get him to fight with the rest of the team, he doesn't want to, he's not interested. He sits back on the couch, eats his potato chips and watches TVs, while the rest of the superheroes or Avengers are out there fighting, trying to fight the forces of evil. And one day, finally, the superheroes who are out there on the front line get beat down, and finally this couch potato finally gets into action and kicks butt, and that couch potato is the inverse ETF. It can be like a superhero to save your portfolio during a downturn if you have a proper amount of money invested in these things and you have other hedges in place just besides inverse ETFs. I would never recommend that you put all of your eggs in one type of basket or one type of hedge, but an inverse ETF is one type of hedge you can utilize to make your life a little bit easier and be a little bit more sophisticated of an investor, because most people have no idea what an inverse ETF is. Try it. Ask somebody what they are. And they're gonna look at you like a deer in the headlight. They're gonna think you're talking medical terminology, but you're not. You're talking investment, son. That's what this is about. And you're gonna be so smart at that dinner table when you can explain what an inverse ETF is and how you're utilizing it in your portfolio. I can tell you that years ago I didn't know anything about these things, but now that I do, I implement them a little bit more in my portfolio as time goes on, and so far they've been working out great, and I'm happy to have those as an investing option without actually having to short the market. So remember, they're great for short-term investing. They're like insurance. It's like dead weight though until the market goes down in your portfolio, so it's just dead weight, but it will spring into action once the market goes the other way, and you'll have extra cash flow to utilize, sell off at a profit to buy back your other investments, which you love so much at a better price. The question of the week comes from Tyler. And Tyler, thank you so much for the support. This is a fantastic question. And Tyler, you always ask great questions. I don't have time to respond to all of them, but I try. All right, Tyler. So Tyler's asking, basically, without reading this all to you, he's asking about short-term taxes on short-term gains, which are when you hold an investment in a taxable account, you sell it off at a profit. How do you avoid those taxes? How do you minimize the tax hit within a taxable account? Because if you understand how taxes work for short-term investments, you'll understand quickly that you have to pay taxes not at capital gain rates. You have to pay taxes at marginal tax rates or whatever income tax bracket you're currently in, which for some people that can be very high, especially if you make a really large gain. Like in his example where somebody was to sell something and make a $500,000 gain, it's instantly going to push you up in a very high tax bracket, and you might be stuck paying up to 37% in taxes because of all that additional income hitting your account. Well, Tyler, there's a few things you can do. There's no perfect strategy, but I think the first thing I recommend is if you know you want to sell off an investment at a large gain, and especially if it's a short-term one, look at what other investments you are holding in your portfolio, and especially if they're short-term. And if there's anything that you have at a loss that you want to sell, or it makes in your mind you no longer want to hold, you sell those investments off at a loss, it's going to help offset your other short-term gains. So if you had a $500,000 gain on NAT, but you had a $200,000 loss in, let's say, an oil stock or something, then the $200,000 is going to reduce your taxable gain to $300,000, bringing it down from $500,000. So that's just an example. So that's basically some tax harvesting you can do, which is going to help offset the tax hit. The other thing you can do, obviously, is invest as much as you can within your retirement accounts, like your IRA or Roth IRA. Now, of course, you're limited to how much you can contribute to those accounts each year, but remember, anything you buy and sell within those accounts, and as long as that money stays in those accounts, you get away with paying any tax. As long as that money is in that account, you're good. So the more you can invest in there, the more you want to do short-term trading in there, then the more favorable tax attributes may be. But of course, then the downside is if you do take a loss in one of those accounts, you can't deduct the loss. The other thing you can do is always try to keep your taxable income, your total taxable income. Think of all the types of income you make. So one reason I utilize the 401k, which I'm not a huge fan of the 401k, but is to help keep my taxable income lower in general, so I can utilize those lower marginal tax rates a little bit better. And so that's one thing I would consider is, if you're going to take out a lot of money in short-term gains, well, then contribute more to your 401k to offset the tax hit if you can. That's something that might make sense in this example. The other thing that might make sense is if you're wanting to do more short-term investing, really take a look at options, or not options, but futures, for example. And I'm no expert at futures. But futures are, even though they're short term, they are taxed at a different kind of rate. It's a 60-40 split, where 60% of that investment is taxed at long-term capital gain rates, and the only other 40% is taxed at short-term rates. And those are very short-term investments. But there's a lot of favorable tax attributes to investing that way if you understand them and want to utilize those. But like I said, it all comes down to good planning. So if you're going to be in a year where you're not going to make a lot of money, because maybe you're laid off or furloughed from your job, especially in this kind of economy, your overall income is going to be down, well then by all means, then it might make sense to take some gains, right? If your overall taxable income's down, it means you're going to be a lower tax bracket. Well, maybe you sell off all of the gain on your short-term investment or even part of it to implement or utilize those lower tax brackets because your total overall income is lower. So those are all things you can do, but it always comes down to, in my opinion, to even spacing out the gain. You can sell it, maybe you don't sell it all in 1 year. Maybe you space it out over a 2-year period to help minimize the tax hit so you don't enter those higher tax rates. So I know that's not a perfect answer, but those are some strategies you can implement. So I appreciate the question. I think it's a very well thought out question, and I think a lot of people will have similar thoughts as you. How do you minimize tax hits? So those are a few things you can do to minimize that hit. I hope that helps. That's the video today. I'm going to wrap it up here. I hope you enjoyed this. I'll have more investing videos to come on this channel, so make sure you're subscribed. If you enjoyed the content, please do me a favor, drop a like. That helps support the YouTube algorithm, gets this information out to more and more people, and leave your comments or questions below. I love talking about investing, and that's one of my favorite areas on this channel. Until next time, I really hope you all have a great week, and I'll see you in the next video. Live life uncaged. Peace.